And in 2023, I think you will start seeing the end of the 11 or 12 year now bull market in the DXY index. And when you talk about the end game, here's what I think.
Welcome to Gold Silver Pros. Searching for the best precious metals deal? Shop with our trusted partner, 𝙂𝙀𝙊𝙍. Access special deals on silver, gold, and platinum through our website or call 307-264-9441.
Hey everybody, this is Rob Kientz with 𝙂𝙀𝙊𝙍.com. We have a returning guest of the program. Lior Gantz from Wealth Research Group is here. We're recording this a couple of days before Thanksgiving on November 22nd. You'll see it out on the program in a couple of days. Lior, thank you for joining the program again. How are you doing today?
I'm doing well. Thank you for having me.
Yeah, absolutely. So a lot has gone on since the last time you came, and a lot of stuff to talk about, but I guess inflation is probably one that people are beginning to worry about a little bit. We've had sort of persistently high inflation all year, although the recent print came out lower. What's your read on inflation? Is that getting better? Is that sort of a head fake, or what do you expect to happen going forward?
I think the second thing you said, I think it's probably a head fake. I don't think that we have reached a point where there's a clear trend in motion. And what you saw right after the November meeting and the encouraging data that basically month over month was 0.4 instead of 0.6. And that's a 33% below expectation. So that was a very encouraging. And if you actually look at that report, the only thing that was really up and took it to 0.4 instead of it being literally flat month over month was rents and shelter. So it was both encouraging because it was 33% below expectations, and also encouraging because you can now isolate the problem basically to rents and shelter. So it's a good thing and a bad thing, because rents and shelter are not that easy to fix, but it also means that freights and entertainment and everything else seems to be better. Of course, this had nothing to do with oil prices or food prices, but in that CPI, that's what we saw. And immediately the Nasdaq had its best day in many years, and this was all due to short covering. So Wall Street is so short that it's short to the point where it's bullish on being short, because it feels like there's going to be a lot of bankruptcies and a lot of restructuring in the corporate world. If you think about the amount of companies that have been losing money on the bottom line for years and years and years, and we're able to grow and hire more people actually because of VC money coming in and understanding this sort of a business model where you lose money, but you grow, take more market share, and at some point you either get bought out because you have millions and millions of customers, and the new buyer knows how to operate the system at a profit, or you turn that system into a profit. But there is no VC money coming into anybody losing. And so a lot of companies, if they're not able to quickly shift their business model, are going to go under. And that's what Wall Street is betting on. So there's so much shorts out there, and you saw short covering. You didn't see new money coming in. That means that Wall Street is also thinking that this was a head fake. And what's interesting is we're going to have the December numbers, and the December numbers are going to be before the Fed meeting. So in November we had the meeting, then we had CPI report. Now we're going to have it the other way: CPI report, and then on the 15th you're going to have the meeting. So not only will the Fed have another CPI report before the next meeting, but they will also be able to react to that. And if you go and browse on Google right now for CME Fed Watch Tool, you can see like how the futures are already pricing in and what they're pricing in. So there's a 75% chance of a 50 basis point rate hike coming in December. And I think that what this represents is twofold. One, I think that if 2020 was the bubble year, and 2021 was the inflation year, and 2022 is the year that the Fed is reining in on Wall Street, I think that 2023 is the year that reining in on Wall Street now trickles down to Main Street. and middle class America, the housing market, and jobs, which are the two most important things for the average person, his job and his house, are both going to come under incredible pressure. And I think for the next 6 to 8 months here, going from today till the June meeting, in my opinion, we're going to see a lot of pain, and we're going to see this becoming a classical recession. I don't know if we're going into double digits unemployment. That's not my base case scenario, but I do think that we're going to see a lot of firing in Silicon Valley. We're already seeing it, like with Twitter and what Elon Musk is doing, basically telling you that with half the workforce, I can do the same amount of efficiency. And I think a lot of companies are going to follow suit. And what's really interesting is if you look at the salaries of Meta employees or Google employees, their base salary is almost the same as in the rest of the industry if you're a software engineer. But the stock compensation that these people receive for years and years was about 10 times their base salary. So you would make 150 a year as a software engineer and would make another 800,000 in stock compensation. That is over. That zero interest rate policy era world where these FANG companies can grow and grow and grow their market cap, and therefore the dilution is bearable, that's over. And I think we're going to see this whole reshuffling, shakeout, reset of the way that we run our economy in the next 6 to 8 months. This is going to be the 6 to 8 months where value, in other words, getting to a bottom line, can you drive your company into profitability, is going to be the only thing that matters. And you're going to see some bankruptcies, you're going to see distress, you're going to see some real estate problems, all of the real structural, political type of recession where it now Biden will care about this. Now he will call it a recession. That's what you're going to see in the next 6 to 8 months. It's going to be a mess for sure. So I think that's what people really need to prepare for. And this doesn't mean that the market now tanks another 50% or that it even tanks. It could be that these signs are what Wall Street needs in order to price in the pivot and the cut and the U-turn that they're looking for. So it doesn't mean that the markets are going to fall over, but it could mean that. So this is not me telling you the markets are going to crash hard. This is me telling you that the recession will now become undeniable. It will become undeniable. So
and to
I think that's important.
Yeah, to explain that, just a point of clarification. Before the video, you were talking about maybe 2 different stages of recession. The first, which you already described, which was the firing of jobs. Amazon also, in addition to, you mentioned Twitter, Amazon announced it would lay off 10,000. So we've got that. It's more on the corporate side, and it has to do with the easy money sort of drying up and corporates having to adjust to that. And then you say, Lior, that there may be the recession that hits the rest of us afterwards. Kind of describe what you think that may look like. Yeah.
So I think startup companies dead. No VC money. This is all going to dry up. In terms of the real estate market, if I'm a buyer, I'm going to wait until the Fed tells me exactly what it wants to do with real estate, because if interest rates are going to go to 7, then I'm overpaying. If interest rates are going to pivot lower, then I'm comfortable buying. But until I know something, I'm not doing anything. So there's so much money on the sidelines in real estate, both from the institutional level and also like the average person. The average person is calling his mortgage broker. His mortgage broker tells him, I don't know if it's going higher or lower, just wait. And so the whole industry is frozen, means that a lot of jobs are not going to get done. Meantime, because there's literally a demand for homes, rents are going to keep going up. So you're going to see the cost of living for the average person go up at the same time as him potentially losing his job. And you said 10,000 jobs for Amazon. They're talking about as much as 500,000 jobs that they're going to cut. So this is huge. Like this is the real reset. In 2020, you had with the pandemic and shutting down and everything like that. He talked about shutting down the world for 3 years, and it was like the end of the world. But the government and the Fed, the popular thing to do was to bail out everything. And, almost everyone went along with it, or the majority went along with bailouts. Now it's the other way. All of the pressure is not to accommodate, not to turn, not to pivot, not to, not to fold under the pressure. They will not change. The Fed will not change. So what will happen eventually is that elections are going to come around the corner at the end of 2024. Mm-hmm. And what you're going to see, I'm sorry, at the end of next year, and what you're going to see is that the political pressure on the Fed to do something where they ease is going to be too much. And that's when I think you'll start seeing the change. In my opinion, it will come sooner than inflation is going to come down. In other words, we are going to be left with a world where inflation will run at 5 or 6% for a few more years. So we're heading into a world where bond yields are going to be pretty high, and a world where inflation is going to be pretty high, and therefore anything that has to do with deflationary assets or tech is going to underperform, and anything that has to do with value and profits here and the now. In other words, if inflation is high, why would you pay for future growth? You want to pay now because that is taxed at the lowest rate of inflation. If you get the money now, then it's here, it's with you. And if you get the money in 1 year, then it's 5 or 6% less than to get it now, right? So that's why value is so important. And I think that's what you're going to see. Also, like, in the last few years when I talked with my brother, who works at a high-tech company, he always used to tell me, Lior, now I run a team of 4, I run now a team of 6, of 8, of 20. Like, the whole definition of his value was how many people are under you. And I think that is going to fundamentally change to the other way. He's going to tell me, Lior, I just fired 4 people, we're doing the same numbers. I just fired 4 more people, we're doing the same numbers. It's all going to be about efficiency. People are going to go to their CEOs and say, hey, we can lose these people. We don't need them. I found a way to integrate this. I found a way to bring in on. So it's all going to be the reverse of what you saw, where the obsession was growth. Now the obsession is going to be efficiency and cash flow margins, bottom line, net income. So that's a huge change. I think that's part of the restructuring. We're not going back to ZIRP at all. It's the end of ZIRP. So I think that people that feel like the Fed is going to cut, they're not going to do it. It's never going to happen. We are now in a new economy, in a new world with high levels of inflation, at least for a few more years. Market forces are creating some sort of efficiencies and deflating many of the supply chain issues, but it's still so fundamentally in the core of the U.S. economy, the inflation problem, because of lack of new houses, and this is going to take a few more years to solve, and because of salaries being so high that this is not something that you just weed out and plaque out by just raising interest rates a few times, even if it's been as aggressive as it's been, Robert. So I think people should really brace for 6 to 8 months of a real bad recession. And I think around June is when the Fed is going to either hold interest rates or talk about taking some sort of a victory lap and making people feel like, hey, the cuts are coming. Or I don't know if they will actually come, but they will signal it. And I think that will be enough to change the tune, at least in the stock market. And it's going to create some relief for buyers and sellers in real estate and in anything else that the Fed is probably not going to raise more. So halting is one thing, or pausing is one thing, but saying, hey, that's it. This is the terminal rate. That's a big statement. I think it will come towards June next year. So next 6 to 8 months, still very, very, very challenging.
I wanted to ask you about something. sort of the more of the end game of where this may end up eventually. I was researching the 65 to 82 era of inflation. There's an article from a gentleman who works for the Fed, the Atlanta Fed, who wrote an article on it and was talking about how that occurred. It started with an Employment Act in 1946 that was passed, which gave the Fed its mandate around unemployment and inflation and those types of things. And it was a pact really between the central bank and the government to usher in an area of growth. And it made sense back then. You just had the Great Depression and the Great War. We need to redo our economy. Unemployment was the single biggest factor. And what they said was economists believed, according to this Fed historian, that we could actually purchase lower unemployment by having some inflation. It was a trade-off. And they thought that it was almost like, you know, you could trade dollars for crypto or something. Let's trade a little bit of inflation because it was so low for a little bit of growth. And then those policies, I would say, kind of metastasized into what ended up being this big inflationary episode over 17 years. And then, of course, Paul Volcker stepping in, raising interest rates, you know, up above 18%, which kind of got a hold of it. Do you anticipate that what we're going through this time will be a similar episode in which the Fed will eventually have to go really high in interest rates? Or do you think what you just described is more of the end game there? Is it going to be a longer period like we had last time, or is it something that we're going to get through in a few years, do you think?
Yeah. So three things that I'd love for people to do. So because I knew this interview was right around Thanksgiving, people have a lot of time, sit down, educate themselves. I put together 3 reports around those topics. If you download wealthresearchgroup.com/Paul, as in Paul Singer, Paul, it's a hedge fund manager titan, a billionaire. I'm sure you know him. He just went on with an investor memo, and he said, look, the risk of hyperinflation is still here. It's still with us. Thank you for showing that. That's one thing I really want people to see, because that guy is not a gold bug at all. And for him to say such a thing is a really important topic. Secondly, about what we said about this being a fake out and not a real trend where we saw encouraging numbers, it's on wealthresearchgroup.com/out, OUT. So if you check that out, I think that will help you understand that this is not a real trend and that inflation is probably going to toy with us for a while longer. And the third thing that we've mentioned, you mentioned the end game and everything like that. I think 2022 was the year of the fake haven. And that's why I put together the /fake. And the reason is, I think that the strength in the dollar in 2022 is because everyone is selling at the same time. The 60-40 portfolio just had its worst year ever. So people were selling stocks, were selling bonds, settling. You get a demand for dollars, just a technical demand for dollars, because everyone's selling out of their assets. And in 2023, I think you will start seeing the end of the 11 or 12 year now bull market in the DXY index. And when you talk about the end game, here's what I think. For one, we're not in the same period as in the 70s. In the 70s, you had a new monetary system starting in 1971. And that was a big part of why inflation ran out of control. A new monetary system. We don't have one. We have a fiat currency system with the dollar as the standard. For now, nothing is disrupting that. So no, I don't think that we're going to go to 18 or 20%. Now, let me say this. If Joe Manchin doesn't get a statue for stopping the rest of the madness that these politicians were ready to cook up and print, yeah, I think we would have gotten to a point where the CPI numbers would have been in the 12s or the 13s. And you know that if CPI is in the 12s and 13s, then the real inflation number is probably over 20, 25.
Right.
And I think he will go down in history books when they study this era, like 20, 25 years later. They will say there was this guy who put his foot down and did not allow this to happen. And I'm not saying this is is political or nothing. I'm saying this from the economic side. He really did something heroic that wasn't expected of him. And I think the other guy, Cinema, can take some of the credit as well. So this could have gotten worse. I think they stopped it in time. I do think that politically speaking, the deficits and everything like that will be a key point of the 2024 elections. So that's one thing I do believe. And also, if you look at what this end game would look like, I think we're going to go into that classical recession in the first half of 2023. People are going to rush to bonds. Bond yields are going to come down. And I think that towards the second half of 2023 is when the Fed capitulates and the stock market begins on a new uptrend. I think for the first year, so between 2023 and the end of 2024, I think the stock market probably stays flat, creating, forming this bottom, but doing nothing special, because there's so much restructuring. All these big tech companies are going to go through huge restructuring. Real estate is in a situation where it really needs to filter through all this new interest rates and all of these new refinancings that are going to happen. But the demographics of America are still so favorable because the millennials are hitting those higher pay grades. They're getting into their prime years in corporate America, and they're forming families. They haven't gotten married for the most part, and they haven't had children for the most part. Now they're going to need to do all of these, and that will require millions and millions of homes. So the big picture is that America, demographically speaking, and from a growth profile, is going to experience a lot of growth in the next few years. But that growth is going to be accompanied by a bear market for the dollar. The DXY index is sitting around 106, 105 as we're doing this interview. I think in the next 5 years, between now and the end of this decade, it can probably reach the low 80s, if not the mid 70s. We're going into a deep bear market for the dollar, and that plays really well for silver. It plays well for gold as well, but for silver especially. So that's how this connects to precious metals, in my opinion. But for the end game, I just think we're heading into a period of higher inflation and normalized bond yields, and a stock market that it doesn't have a lot to offer yet. I think that we need to still see some more growth and better valuations for the stock market to start rallying. P ratios are not that cheap. This is not a 2008. This is not like a full-blown crisis with 10 to 15% unemployment and a lot of slack that needs to come back. This is almost like you had a Ferrari with too much horsepower, and you were trying to ride it around the city streets, and you were bumping into these curves, and you couldn't park it because it's not built for the streets of a city. And you had to go to the mechanic and actually take some of the horsepower off, maybe take the turbocharger out. You need to make it work for the city. But once you make it work, you still have a brand new Ferrari and you're driving around the city. And that's the difference. I think we have just too much inflation. But overall, I think the picture for the U.S. economy is way better than the picture for the Europe economy or in Asia. The demographics look much better here. People still want to do business in America first. Innovation is still, America first, and I don't think those things are changing soon. So that's basically the big picture. But it doesn't mean that this is going to go anywhere close to smooth in the next year or two. I think there's a lot of restructuring that's going to happen as we end the biggest monetary experiment of our time with the ZIRP.
Yeah, and I think that restructuring has been pointed out by researchers like Rogoff and Reinhardt, who wrote, that seminal paper after the last recession and talked about 90% debt to GDP and how nations who have reached that historically had to suffer high inflation rates and had to restructure financially. And then after they did that, a little bit of normalcy, or at least a new period of growth would begin. And you're thinking this period of kind of sideways restructuring, that type of thing, could take a few years. But real quickly, just paint the picture of where you think we could hit growth again, and what does that look like? Do you suspect that will be opportunities for new industries? For example, 2000, 2001, a lot of the previous .com companies went out and a bunch of new ones formed. It was opportunities for new ones like Amazon, and for Microsoft to basically reinvent itself. And for Google and a lot of those companies, what opportunities do you see that may come about as a result of this restructuring?
Yeah, I think the biggest thing is what we have, Robert, is we have a deglobalizing world.
Mm-hmm.
And in a deglobalizing world, supply chains become way more complex. So I think you will start seeing every company employing a chief supply chain officer.
Mm-hmm.
that the only thing he will do is work on the warehousing side and everything that has to do with making sure that the shipments arrive in time and go to the right places and everything like that. This is going to be a complex problem. In a globalized world that we've been living in for the last 30 years, the trade-off was outsourcing America's high-paying middle-class jobs in exchange for getting an abundance of products and services for prices that obviously America can't manufacture at the same prices. But now we're going to see a lot of domestic manufacturing coming back, but not in the not in cotton and shoes and air conditioning, the easy stuff. There's going to be a lot of manufacturing at the highest level, the cutting edge level, done in America. I think that outside of major cities, where you go, an hour and a half outside, and it's those rural areas, you're going to see new manufacturing hubs, fully automated, robotic. You need a lot of engineering, a lot of designing for that. I think these hubs are going to supply cities instead of getting stuff from halfway across the world where these guys are still playing COVID. You want supply chains to come from 2 hours from your city, where the rules, the regulations. These ships are not gonna suddenly dock for 10 days outside the port because they have one patient or stuff like that. You don't have to work with the port authority that much. So these are changes that are going to happen with supply chains. They're going to become way more domestic and way more automized. That means a lot of high-paying jobs, by the way, for designers, and software and everything like that. Also, because you're not in a globalized world, you're in a deglobalized world, there's going to be a lot of hedging of commodities. And I think commodity prices are going to stay high for a few more years because, if America wants lithium, it goes to South America. But if China wants lithium, it also goes to South America. So now South America, in order to secure supply with it, the Chinese or the Americans are going to have to pay a premium. They're going to have to pay more because they will want to say, hey, I need 4 tons of this thing, and I want to pay as much as necessary for you to not undercut me and go to somebody else. How much do I need to pay? And so you live in a world where capitalism is becoming political capitalism, and that means you pay a premium for a lot of things. This obviously will go on in Europe, where they need to completely change the whole way that they supply their continent with natural gas and oil and coal, and obviously uranium that's going to come back big. So these are huge changes. So you're asking me opportunities. If I had a kid who was just off, finishing college in America, I would say go to the energy industry. You will find so many opportunities there in energy or supply chains. Manufacturing, robotics. Those are things that are going to be important. Cybersecurity. How many people are not going to go back to a 5-day office? If I work for a very high-tech firm, keeping a lot of secrets, commercial secrets, that is, I need security in my house. I think there will be companies that's all they'll do. They'll come to somebody's house. They'll make sure that the office that he works in, the space that he works at, is completely secure. And these are going to be things that companies consider, and these are going to be opportunities for entrepreneurs because people are going to work way more hours from home. I think that home design and architecture is going to see a boom. I mean, there's like a like a food chain, like an ecosystem. Once you change one thing, all the other ones are getting impacted, and that's basically what you're seeing right now. You are seeing the end of this 2009 to 2022 era of zero interest rates policies and growth in the tech sector and hiring for hiring's sake. All that's over. We had 2 disruptive events. We had basically we had the pandemic creating disruptions, and then we all found out that we don't like each other. Like countries found out that they're very different from each other. That's what I mean. And it exacerbated it. And now we live in a world where, a lot of different regions are acting differently, and that's going to impact how we interact with each other. So I think that those are all huge opportunities, all restructuring opportunities. I named a few, but I mean, this can go on for a very long time. I think that the millennials have their own taste in fashion and the what you call it, like ESG. That it's important to them. You're going to see a lot of that going around, and I think that obviously the more you put ESG compliance on miners, the higher the prices you're going to pay for commodities as well. If you tell somebody that digs a hole in the ground that once he finishes this in 20 years, he will need to put this whole thing together and build a park over it. I mean, you're talking about hundreds of millions of dollars that he needs to factor in reclamation costs. So all of these things are going to be critical for what we do. And at some point, in my opinion, this divisiveness that we have in America, that's insane right now. I think that the extremes are going to become too much for people to handle. People will be tired of the extremes, and that's when you're going to see people coming to the middle and working with each other. You have to have that because what we have now, it's tiring and it's not effective.
I agree that. I want to expand upon just one of the roles you said that could be successful in cybersecurity. So I have a master's in information assurance, which is basically cybersecurity. We just give it a different name. And I worked in that field for a long time. My last role was working at Verizon, securing their 5G network. So their new, multi-billion-dollar network that everybody's building around the world.
Okay.
Cybersecurity may be one of the biggest opportunities for new college grads that I can recall in my lifetime. I'm 48. I've never seen such a demand for a position that did not have qualified people. And I just mean trained people with an interest in that stuff. It is a absolutely huge field. I've been out of it for about a year. I left my job at Verizon to run the business full time. And I just got a call back, they want me to come back. And they said, we can't find anybody with your experience and skills, and we can't find college grads we can teach up. So companies in America need, in the worst way, cybersecurity people. So if you're a parent out here and you have a child trying to figure out what to do and they have any interest in computers and security, even if they don't, tell them to go into cybersecurity. It is a wonderful field in which we all need, many, many, many more good people. And it's a tremendous opportunity. And I can speak from experience. Being in the computer field and cybersecurity for 25 years, it did wonders for my own learning, but also opportunities that I had. So 100% want to edify that point. Cybersecurity is huge. Moving on to the last.
Warren Buffett even called it the biggest threat of our times, cybersecurity. So
who did?
Warren Buffett.
Yes,
he's
I
a
agree with
professional
him.
investor, if you know his name.
Yeah, the most influential investor maybe of our modern times for sure. And the cool thing about Warren, he's a value investor. So he really fits in with what a lot of our audience looks at is we want to find value. So one of the last questions I want to ask you is about gold and silver. Of course, is a gold and silver focused channel. A lot of people getting into gold and silver are looking for things to stabilize portfolio and for value. What's your view on gold and silver going forward, given everything that we've talked about?
Okay, so I think the next 6 to 8 months very tough for silver as recession fears, make a quasi-industrial metal like silver, which is precious metal to the retail side, but from the institutional side, it's very industrial. I think it hurts it. I think that gold is during recessions tends to outperform stocks. So I think that actually for next 6 to 8 months, gold has probably a better chance than silver. But once the Fed pivots, in my opinion, it will happen around June. I think that the dollar will top and create what I call a generational peak. And that generational peak will probably begin a very long bear market for the dollar. And if that's the case, I think that silver is going to go in the next 5 to 6 years here, as we go in towards 2029, 2030, I think silver has a really good chance of hitting 60 an ounce. And in that same time, I think that gold can probably do anywhere between 2,500 and 3,000. So I'm very bullish on both. I'm far more bullish on silver once the Fed pivots. And I do think that because the dollar will peak, but inflation will remain fairly high and bond yields will remain fairly normal, I don't think that people will go immediately, Wall Street will go immediately straight to tech. They didn't after the dot-com bubble, and I don't think they will now. I think that what's going to be the most interesting companies, so the companies that Wall Street is going to be focused on, are going to be the small cap value companies. In other words, companies that are between $1 billion and let's say 10 to 15 billion market cap, and are actually creating a net income on the bottom line. And they are basically these little profit machines. And I think those are the ones that are going to be the ones that outperform in the next 5, 6 years. Not the FANGs at all, but the smaller companies that are more nimble and are now growing and are actually able to create a net income. In our newsletter, if you're a subscriber, if you going to subscribe, we are going to feature our top 10 small cap value companies for 2023. In the next few years, weeks here, as we ramp up the year, we're going to showcase them. And these are companies. All the companies are going to be companies that I personally invest in and buy positions in, and I don't tend to. In other words, these are companies that I'm going to be invested in for years and years, that I think have a growth profile that gives them the potential of at least creating either 4 or 5 or 600% in the next few years. These are the top 10 that I'm looking at.
Okay, and you share a lot of what you're investing in or interested in for your subscribers. Explain to people how they can get that information and how they can find more about you.
Yeah, wealthresearchgroup.com is the website. On the homepage, you can subscribe to our free newsletter. It goes out every Sunday, Tuesday, and Thursday. And yeah, I do basically, I do 3 things. I talk to hedge fund managers. I talk to real estate managers. Then I research the economy on my own, using my own resources. Some of them are very high-end paid research. And then what I do is I pack them all up into 3 articles a week and marry that with personal things that either I invest in or that I'm just researching and I want to share.
Awesome. Thank you so much, Lior, for being on the program. We'll have you on again. I think we have you on about once every quarter to give us your view. It's always a very popular one. Thank you so much for returning to the program, and have a very happy Thanksgiving.
Thank you. Thank you, sir.